Hello there, this is James and you're watching Tixee Live. And a very good afternoon to all of you, and all of you a very happy Monday. In today's little program, I want to discuss a debate going on between two very high profile analysts about how they see the future of the market, as well as have a little discussion about the dollar is giving up some of its gains from Friday and the continued pressure on oil. But before we get into that, don't forget these little videos are for educational purposes only, and in no way whatsoever should ever be taken as financial advice. I always suggest you do your own research and do your own due diligence, and of course, know the risks at hand before entering any trade. We've had out the way. Let's get started. Now, I talked about these two individuals before. They're very highly respected analysts, but they do have very different views on where they see the market going in the near to medium term. Now, let's start off with the one who is bullish on the market. This is JP Morgan strategists. I can never say his name correctly, so forgive me. Mislav Machaka. He's bullish. He's considered very, very bullish. And this is what he recently said in his recent opinion after the job number came out last week. He said recently, "We believe that risk reward for equities is not all bad as we move into year end." He goes on to say, okay, he says, then, in fact, we argue that we have entered the phase where weak data flow can be seen as good, leading to the Fed's policy pivot, and the activity slowdown is less deep than feared. So basically, what does he mean by that? Well, in his opinion, every time you get weak data is good news. Remember, we've had this sort of conversation before in other videos where I've often said good news, or sort of bad news is good news. Okay, because what he's thinking, and in his opinion, and I'll talk about the other opposing view and how I see things. Okay, in his opinion, when we have bad data, this will put the brakes on the Fed. So this will hold the Fed back from being aggressive with interest rate hikes, which I think is a bit wrong there. I don't think they will do that, and I'll tell you my opinion on that in a bit. So that's what he means by that. So he means that weaker data, the Fed won't be so aggressive. Same time, what he's saying, activity slowdown is less deep than feared. He's saying that, look, it's not, though we have got signs of weak data like the US GDP 2 weeks ago, coming in negative 0.9. He says it's not that bad. It's not as bad as everybody thought. However, this is his opinion. His opinion. On the other side of the argument is a very well-known bear, and his name is Mr. Mike Wilson of Morgan Stanley. He has a very different view. He says slowing corporate earnings growth, to rising rates and bruising inflation are in place for the S&P 500 to take out June's lows sometime by the fall. So he believes the absolute polar opposite to the rival at JP Morgan. Okay, his belief is we're actually going to see further sell-offs. We're actually going to see the S&P 500 test the lows it was trading out back in June. In fact, that would be an 8% drop as it currently stands. And don't forget, S&P 500 has had one of the worst starts to the year since 1960s, I think it was. So yeah, it's not very like I say, he's bearish. And to be fair, in Mr. Wilson's defense, not Mr. Wilson's defense, but to add on to what Mr. Wilson's saying, Mr. Wilson correctly called the sell-off at the beginning of the year. So though he is very bearish, he was right at the beginning of the year. And to be fair, where I land in it, or where I stand in it all, I'm very much bearish with like Mr. Wilson, because I think the market is kidding itself after the FOMC statement 2 weeks ago and the press conference. They all thought it came across as slightly dovish, but not overly dovish in my opinion, but slightly dovish. I think the market is convinced itself that the Fed won't be aggressive to raise 75 basic points. I think they're wrong. I think the Fed will raise 75 basic points. And I think that we haven't got some very good job data. We should be really interested. I'll tell you what, I'll be really interested with that job data. I'll be really interested to see what it is next month and see what the revised figure is, if they revised it lower. So I'd be really interested. Anyway, that's a different thing. But like I say, I think that the Fed is really going to be really aggressive, and I think the market is building and putting itself in the false sense of security that Feds are going to be gentle. And I don't think the Fed is. I think the Fed will be aggressive. And I've got a point on that, because the hawkish talk is continuing. Hawkish talk is continuing. Now, a Fed governor, one of the members of the committee, Michelle Bowman, she said in a statement on Saturday, I supported the FOMC's decision last week to raise the federal funds rate by another 75 basic points. She goes on to say, my view is that similarly sized increases should be on the table until we see inflation declining in a consistent, meaningful, and lasting way. So she, again, is underlining her personal belief and the Fed's commitment to bring inflation down. Don't forget, their target is 2%. And they're currently, in inflation in the US is currently at 9.1%. 2%, but it's actually 9.1%. So they have a long way to go to bring that down, to bring it down. In fact, I mentioned this this morning, okay? The CME group, they have a Fed Watch tool where they sort of try and predict what the Fed is going to do. As it stands, the Fed Watch tool now says they are 68.5% chance of a 75 basic point hike in September versus what it was last week before the NFP came out at 29%. So yeah, in general, it is all down to what, I mean, the market generally is what I believe, like quite a few people, but the market's not kidding itself. I believe that it will be 75 in September. It will be 75. And I think the market is kidding itself if it thinks the Fed is going to be gentle. But don't forget, anyway, the big event is coming up to basically back up my opinion and back up the opinion of Mr. Wilson as well, and many others out there. We're not just the only ones. But don't forget, to back this up, Wednesday, massive event. And in many ways, the market is waiting for this event at the moment. And we'll have a look, see what's going on in the market in a minute. But the market is waiting for this event. And that is the US Consumer Price Index, inflation. Okay? Now, don't forget, last time, it totally shocked everybody, completely shocked the market. It was supposed to come in at 8.9%. It came in at 9.1%. Okay, so catching up to the UK, which is at 9.4. Expectation this time around is that it's going to be 8.7%. But even if it comes in at 8.7%, their target is still 2%. It's still 2%. So anyway, I think this is going to be a major event. The market is indeed waiting for this. And because of that, don't forget, I'm going to be doing a tixee live watch along of this event. So I'll be going live 10 minutes before this event happens, so we can watch it together and see how the market reacts. Well, we'll do the usual, go through several scenarios of what could happen on this announcement. So don't forget, 12:20 p.m. UTC on Wednesday, I'll be doing a watch along, so please come along and join me. What I think is the main event this week, which I think the market is holding its breath for in anticipation, because I say this will then fuel people like myself and other analysts who think, yes, the Fed's definitely going to do 75 basic points, at least in September. Anyway, so don't forget, Wednesday, 12:20 p.m. UTC. Okie dokie. Oh, hello, Philip. Good. Well, it's afternoon for me, actually, but yeah, evening. Good evening, Philip. Actually, no, the retail sales actually performed quite well last time. Good evening, Philip. Isn't it late? Isn't it too late for you? Anyway, it's really great to see you, my friend. Great to see you. Actually, retail spending is actually still the same in the United States. It came out last reading of the retail sales. It was supposed to come in at 0.6, about 0.8%, I think it was. And it actually came in about 1.6%. so slightly better than expected. However, it was, in my opinion, and when you looked a bit more into it, it was quite a misleading figure because majority of that was fuel and petrol and food, not the day-to-day, not the luxury products like jackets and watches. So though it was a good figure, it was slightly, when you looked into it, it wasn't so good. But anyway, it was still higher than expected. Oh, you're such a charmer, Philip. You've made my day. Really nice. But it's so nice to see you and to hear from you again, buddy. It really is. It really is. Right. Yeah. So anyway, Philip, always a pleasure, my friend. Always a pleasure to see you. So let's have a quick look at how the market is acting at the moment. Because don't forget, on Friday, on the back of that shocking NFP number at 528,000 new jobs created versus the expectation of 250,000, we had a lot of dollar strength. But today, like I say, as I said earlier on, I think the market is sort of is holding its breath, is treading water a bit. The dollar's given up a fair bit of its gains against some of the majors, not massively, but a little bit. But let's have a quick look at some of the pairs at the moment as it stands. So first of all, euro dollar. Okay. Like I said, the euro dollar on the back of the better than expected NFP actually dropped all the way down to 1.01295. It's managed to recover slightly, and it's just a little bit over the 1.20 level now. Currently trading at 1.02043. Obviously, we can see we're finding a little bit on a short term. This is on a 30-minute chart. Don't forget, a little bit of selling around the 100-day moving average, which is just around about there now. So yeah, the cable. Sterling dollar, again, same as the dollar, same as the euro, came all the way down. Remember, it touched that key area of interest, which we put in a little while ago, that 1.20034. So that is a key area of interest, a key potential support. Touched it and bounced and retraced back. So it's managed to recover actually better than the euro, to be honest, because it was here before the NFP. So it's getting close again to where it was before the NFP announcement. Currently trading at 1.290, but I can see that obviously that 200-day moving average could potentially be an area of interest there for support. The one area I'm watching more in particular, though, which I think if it can touch it and break it, we might see some bullish momentum with the cable, is 1.21976. Let's look at the dollar yen, because the dollar yen briefly again touched, went above the 135 level. Again, like I said, the dollar's given up a little bit of its gains. Currently now under that key level 134.70. So that'd be an interesting area to watch as a potential resistance now in the short term, maybe. So keep an eye on that. Currently trading at 134.44. Gold, of course, as everybody knows, I'm a gold bug. I do love yellow metal. Gold, again, same story across the board. The dollar's given up some of its gains. Currently trading at $1,785.86. Still, though, way below that key level of 1,791. To add on to the fact that we have got a little bit of risk appetite on the market, we have got Bitcoin has performed pretty well with risk appetite on the table. Currently trading at $24,124. So we got risk on. Is actually up. The cryptocurrency, number one cryptocurrency, is actually currently up 25% since the start of July. So yeah, that's performing quite well too. A quick look at the markets as well. S&P, again, opened up slightly higher, has recovered after that dramatic drop in which you went through on the back of obviously that shocking NFP number. Currently trading now at 4,179 points. So that's where we are with the market at the moment. In other news, excuse me a second, press the big tray. In other news, oil still is pressured by demand concerns. It's still under pressure. Don't forget, last week when we looked at oil, it actually had gone down to the levels it started to trade at back in the beginning of February before Russia invaded Ukraine. In fact, last week was such a bad week for both the two main oils. Brent had tumbled by 13.7%, and WTI had dropped by 9.7% last week. So a lot of pressure on oil. And don't forget, the reason for this, of course, is that It's no longer about the supply issue dominating the mind of oil traders. It's the fact that demand may be waning. That shocking EIA report, which stated there was 4.5 million barrels in storage, opposed to the expectation of 600,000 barrels, and 200,000 barrels of gasoline, opposed to a negative expectation of 1 million barrels of gasoline. It's really giving the impression to the market that the biggest consumer of oil, which is obviously the United States, they're not buying so much of it. Demand is waning, and this is why oil is under pressure. Lock in, plus with all the concerns with China and the lockdown as well, the zero tolerance to COVID. So that is weighing on it. So let's have a quick look at oil as well. Let's have a quick look where we are with oil, which is good news for us people who drive cars. Eventually, the prices will start to drop too. So anyway, yeah, currently, like I say, under that key level of $89.54, currently trading at $88.16. Brent under $100 as well, currently trading at $94.76. If you put it on a daily, we can see how dramatic this turnaround has been. Like I said, remember, this is where Brent was in February before the invasion happened, and it skyrocketed. It's now practically down to where it started off in February. Oil, WTI, is even below where it started in February. So a lot of pressure on oil currently at the moment. Okie dokie. So major events this week is all around, like I say, it's all inflation week. That's why I say happy inflation week. German CPI, US CPI, US initial claims, UK GDP, US Michigan sentiment. And like I said, it's all going to be about this week. This week, the market is going to be obsessed by it and basically waiting for it for Wednesday, the US CPI. That is going to be the big one this week. And that's the one I'm going to be doing a watch along for that. So please come and join me for that. So I think it's going to be really exciting. I might scream even louder than I did when I saw the NFP result on Friday. Those who are kind enough to join me, you know what I'm talking about. Anyway, the market says it currently stands, like I say, slightly risk appetite. FTSE currently up 0.78%. DAX currently trading 1.24% higher. And New York Stock 50 currently trading at 1.13% higher. So there we go. That's what's happening. Don't forget, you can ask me questions anytime. Oh, looking forward to it. Yes, me too. I am really looking forward to the US CPI. It's potentially going to be a really big event. And I think I'm very excited about it. I'm very excited about that one. Like I said, don't forget, you can say, ask me questions anytime you wish, or just simply say hi if you like, or share me your opinion. You know, what do you think? Are you excited about the CPI as much as I am? Side topic, Philip. Side topic. Thoughts to the first round of the English Premier League. Well, I'm a Man United fan, so not a happy chappy on the first round of the English Premier League, buddy. But nice question. Who do you follow? Who do you support, Philip? But yeah, no, I'm a Man United fan, but have been since I was a wee kid in 1985. And you've got to take the highs and the lows, the peaks and the troughs, the sports and the resistance in football, just like you do in trading. But yeah, I know. No, not so much now, is it? Not so much. Oh, you're in United as well, are you? So you're both you're sharing my misery as well, then, Philip. You're sharing my misery as well. But yeah, of course, great minds think alike. That's good for you, buddy. Good for you. Yeah, look, we got to stick by him, man. You know, you stick by your side when it's good times and bad times. And as I often say to my my girlfriend, who's also a United fan, I say, got to remember, the larger the ship, the larger the turning circle. So yeah, always bear that in mind. We'll get there. Anybody else want to ask any questions or share mine and Philip's misery about Man United at the weekend? No. Well, don't forget. If you ever think of a question later, or a topic or something else you want me to discuss, maybe, write in the comments below, either on Facebook or YouTube. I will see them, and I will reply to them next time I'm going live. And don't forget, that's going to be tomorrow. In fact, I'll be going live again tomorrow at 8 a.m. UTC, and again around this sort of time in the afternoon. We'll have a little chat to see how the market is looking. Whether or not it keeps this bullish momentum up, I'm not sure. I'm convinced about that. But anyway, yeah, don't forget that. If there is no further questions in that case, not to worry. Like I always say, then if you're watching me on Facebook and you like this little episode, give us a follow if you like. If you're watching me on YouTube and you've quite enjoyed this little video, subscribe if you like. Hit the notification button so you know next time I'm going live. If you enjoyed this video and put up with me my over-the-top enthusiasm for the markets, which I just can't help because I love the markets, then give me one of these. It's always nice to know that you like what I do. On that note, big shout out to Philip. Great to see you again, buddy. Big shout out to SMF 790 as well. Great to see you again. And a big shout out to all of you who've come along and watched me today. I really, really appreciate it. Till next time, don't forget these little videos are for educational purposes only and in no way whatsoever should ever be taken as financial advice. I do suggest you do your own research and do your own diligence. And of course, know the risks at hand before entering any trade. Till next time, every single one of you, trade safe.